Howdy there, Internet people. It's Belle again. So today, we're going to talk about what stocks and bonds are telling us about the future. The headlines were out there. After the election, the stock market hit record high. And of course, Trump is claiming credit. It's true, there were record closes on the 6th and 8th of November. But if you're going to give him credit for those two record closes, you have to explain the previous 7 record closes in October. I'm sure some will say it's because people thought he was going to win. Then you have to explain the 40 record closes this year prior to the election. Trump is riding in on a stock market heading the right way and claiming credit for it. But more importantly, the stock market should go up right now because of Trump taking over. Trump is talking about giving the rich more tax breaks. That's good for the boss. Those tariffs that we'll have to pay will give the companies an excuse to raise prices and increase revenue. But here's your periodic reminder that the stock market isn't a good indicator of the overall economy, or whether a president is good for the economy. Do you know what else happened while the market was continuing its rally? Bond yields went up. Long-term Treasury bond yields shot up, and generally they go the same way interest rates go. So they should be going down. Now, there was probably a little emotion in the climb in yields, and the interest rate cuts might push the yields back down. To know why this matters, you have to really get what a bond is in this context. A bond is money lent to the federal government. The yield is what the person loaning the government money will get for loaning that money. When the yield goes up, that means it's seen as a riskier loan, which means the future economy is in question. It's just like one of us with a car loan. The better your credit, the lower your interest rate, because the bank sees you as less of a risk. If your credit is bad, the bank wants a higher return for taking the risk. They want a bigger yield. So, why do investors want more of a return? They're worried about Trump's tariffs, tax cuts, and so on, and how they will impact the economic health of the U.S. overall. Remember, the stock market runs on emotion and company profits. The bond market runs on fundamentals and stability, and maybe a little pessimism. The concern is increased deficit spending under Trump and his tariffs blowing the soft landing and reigniting inflation. To continue with the car loan analogy, you're in the middle of the loan application and you tell the loan officer, "Yeah, these papers show what I've made the last 2 years and my expenses, but I just quit my job and got an apartment that costs twice as much as the papers show." I'd expect the bond yields to level off and maybe even drop a bit before they start to go up again. But this, much like Grandma's copper price down and gold price up metric, is something you should keep an eye on. Anyway, it's just a thought. Y'all have a good day.